something just triggered in the bond market. Not a headline, not a viral tweet, not a central bank emergency meeting, a signal. And historically, when this signal flashes, recession tends to follow. The signal in question is the yield curve, specifically the relationship between short-term and long-term government bond yields. When short-term rates rise above long-term rates, the curve inverts. That inversion is not normal. Under typical economic conditions, long-term bonds yield more than short-term ones because investors demand compensation for time and uncertainty. But when markets expect economic slowdown, long-term yields fall relative to short-term rates. Investors begin pricing in rate cuts before central banks announce them, and that is where things get interesting. In the United States, yield curve inversions have preceded nearly every major recession over the last half-century. The signal does not predict timing perfectly, but its track record is difficult to ignore. When the curve inverts deeply and persistently, it reflects tightening financial conditions and expectations of weaker growth ahead. Right now, that inversion has reached levels historically associated with downturns. But the yield curve is only part of the picture. Leading economic indicators have been softening. Manufacturing activity has cooled. Credit conditions have tightened. Corporate borrowing costs remain elevated after aggressive rate hikes by the Federal Reserve. Higher interest rates slow housing. They slow investment. They slow consumption. Eventually, they slow employment. And when employment weakens, recession becomes visible rather than theoretical. So where does silver enter the story? Silver sits at a unique intersection. It is both an industrial metal and a monetary asset. During economic expansions, industrial demand supports price stability. During monetary easing cycles or financial stress, its monetary characteristics attract capital flows alongside gold. Historically, when recession risk rises and markets anticipate central bank rate cuts, precious metals begin pricing in looser policy before it is officially announced. Lower rates reduce the opportunity cost of holding non-yielding assets like silver. If real yields fall, meaning inflation remains elevated while nominal rates decline, metals often benefit. But silver behaves differently than gold. Gold is primarily monetary. Silver is partially industrial. That means silver can initially struggle during early recession fears if industrial demand expectations weaken. However, once policy easing begins and liquidity expands, silver tends to move aggressively, often outperforming gold in percentage terms during strong bull phases. This is where the $100 narrative comes from. In prior precious metal cycles, silver has experienced explosive upside once momentum builds. The move from the mid-teens to nearly $50 during the 2011 cycle happened rapidly once liquidity conditions aligned. The question now is whether the macro setup resembles past explosive periods. Let's analyze the conditions. First, debt levels across major economies are significantly higher than in previous cycles. That increases sensitivity to interest rates. If recession emerges, policymakers may be pressured to cut rates quickly to stabilize growth. Second, global liquidity conditions matter. If central banks pivot from tightening to easing, capital often rotates into hard assets. Third, inflation expectations play a role. If recession hits but inflation remains above target, real yields could fall sharply during rate cuts. That environment historically supports precious metals. But we must also consider downside risk. If recession becomes severe and deflationary pressures dominate, industrial demand for silver could weaken substantially. That could cap initial upside. So reaching $100 would likely require a specific sequence. A confirmed recession, rapid central bank easing, falling real yields, renewed liquidity expansion, and strong investor demand for hard assets. That is not impossible, but it is conditional. Another variable is positioning. Speculative positioning in futures markets can amplify moves. When sentiment shifts from cautious to bullish, price acceleration can become nonlinear. Silver's market size is smaller than gold's. That means capital inflows can produce outsized percentage gains relative to other assets. However, volatility cuts both ways. Silver tends to overshoot in both directions. During panic liquidations, it can drop sharply before rebounding. So what is the recession signal really telling us? It is not guaranteeing collapse. It is signaling stress building within the credit system. And when credit tightens enough to tip growth negative, monetary policy typically shifts. Markets front-run that shift. If investors begin anticipating aggressive rate cuts, silver may start moving before official confirmation. The key metric to watch is real yields. Nominal Treasury yields adjusted for inflation expectations. When real yields decline meaningfully, metals gain relative attractiveness. We are approaching an environment where that dynamic could emerge, but timing remains uncertain. Yield curve inversions can persist for months before recession materializes. That lag period often produces market volatility and conflicting signals. Some data points improve, others deteriorate. Equity markets may rally on rate cut hopes, even as economic fundamentals weaken. Silver thrives on liquidity expansion, not just recession headlines. So, The path to $100 is less about the word recession and more about the policy response that follows. If the signal that just flashed forces aggressive monetary easing in a high debt environment, precious metals could enter a powerful cycle. If policymakers manage a soft landing with controlled disinflation and stable growth, upside may be more moderate. The yield curve has spoken. The question now is whether the economic slowdown it implies will trigger the kind of liquidity wave that historically ignites silver. Because in macro cycles, metals do not move first. They move when policy pivots, and if that pivot is coming, silver may already be preparing for it. If the recession signal is real, then the next phase is not about fear. It is about response. Recessions do not move markets by themselves. Policy reactions do. When economic contraction becomes visible, central banks shift from fighting inflation to protecting growth. That transition changes liquidity conditions, bond yields, and capital flows, and silver reacts to liquidity more than headlines. So let us map the possible sequence. First comes economic confirmation, slower hiring, weaker manufacturing, falling consumer confidence, credit spreads widening, equity volatility rising. Then comes policy recalibration. In the United States, that typically means rate cuts from the Federal Reserve. Markets do not wait for official meetings. They price cuts in advance through bond markets. When short-term yields begin falling rapidly, the yield curve steepens again, not because growth is strong, but because policy is easing. That is often when precious metals accelerate. But silver's path is more volatile than gold's. During the initial shock phase of recession, investors often liquidate assets broadly to raise cash. In those early moments, silver can drop alongside equities. We have seen this before. However, once liquidity injections begin and real yields decline, silver frequently outperforms. The key variable is real yield compression. If inflation remains moderately elevated while central banks cut rates aggressively, real yields fall. When real yields fall sharply, holding cash becomes less attractive. Capital seeks assets with scarcity characteristics. Gold benefits. Silver, because of its smaller market size and dual industrial monetary identity, can move faster in percentage terms. Now consider the structural backdrop. Debt levels globally are higher than in past recession cycles. Governments are more sensitive to high interest costs. That means policy easing during downturns could be faster and more aggressive than many expect. In such a scenario, liquidity expands rapidly. If quantitative easing returns, even indirectly, capital flows into hard assets may intensify. This is where the $100 thesis gains traction. Silver does not climb in a straight line. It moves in waves. Historically, once momentum builds, price expansions can become exponential because supply growth is relatively slow, while investment demand can spike quickly. Industrial supply constraints also matter. Silver production is often a byproduct of other mining operations like copper and zinc. That means supply does not always adjust quickly to price changes. If investor demand rises while supply remains constrained, price pressure builds rapidly. However, a move to $100 would require more than mild recession and modest rate cuts. It would likely require aggressive monetary easing, sustained decline in real yields, strong investment inflows, continued inflation uncertainty, weak confidence in fiat purchasing power. Without those conditions aligning, upside may be significant but not extreme. There is also a geopolitical angle. Periods of economic stress combined with geopolitical tension often increase demand for tangible assets. If global uncertainty rises simultaneously with recession risk, metals gain additional support. But we must acknowledge the downside risks. If recession turns deeply deflationary, meaning demand collapses and inflation falls sharply, real yields might not decline meaningfully. In that case, silver's industrial side could weigh on price performance. That is why silver is more volatile than gold in downturn cycles. It is both opportunity and risk compressed into one asset. Another factor to monitor is investor psychology. Silver markets are smaller and more sentiment-driven than broader equity markets. Retail participation, futures positioning, and ETF flows can amplify price swings. When momentum traders enter, rallies can overshoot fundamentals. In the previous major cycle, silver's move toward its historic highs happened quickly once liquidity conditions aligned. It was not gradual, it was explosive. That is why discussions about $100 emerge whenever macro stress and easing cycles overlap. But timing is everything. Yield curve inversion is an early warning, not an immediate catalyst. There's often a lag between inversion and recession. There's also a lag between recession and full-scale policy easing. Markets oscillate in between. Silver may experience volatility before a sustained breakout occurs. The smartest way to view the $100 narrative is not as a prediction, but as a conditional outcome. If recession triggers aggressive liquidity expansion in a high debt, high uncertainty environment, silver's upside potential increases dramatically. If the slowdown remains mild and inflation falls cleanly without financial stress, silver's gains may be more contained. The signal that just flashed suggests economic stress is building. But the magnitude of silver's move will depend on how policymakers respond and how deeply confidence in financial stability is shaken. In macro cycles, metals move when trust in paper stability weakens and liquidity expands simultaneously. If that combination unfolds, silver's volatility could turn from threat to fuel. And while $100 may sound extreme, in markets driven by liquidity waves and compressed supply, extreme outcomes are not impossible. They are simply rare until the right conditions appear. The recession signal has flashed. Now the world waits to see how powerful the response will be.